Welcome to the Deep Dive. We're the place you turn to when you want to understand these, well, complex shifts happening where traditional finance meets the digital world.
Right, we unpack these big movements and try to give you the knowledge you really need.
And today we're diving into something that's really forcing a conversation about what a safe haven even means anymore.
We're talking about gold. It's been all over the headlines, hitting record prices, with all the geopolitical jitters and inflation worries, definitely. But running right alongside physical gold is its digital cousin, crypto digital gold, things like PAXG and XAUT. It's a really timely topic. You heard people back in, October, pointing to that moment when gold was up and Bitcoin was down.
Oh yeah, the see, told you so moment from traditional finance. The stable asset wins.
Exactly. But, the picture gets a whole lot murkier when you actually look at these tokenized gold assets. They were right there in the mix, trying to bridge these two seemingly opposing worlds.
And that's the paradox, isn't it? That's what we're really digging into today.
Our mission, if you will, is to get deep into these specific tokenized gold offerings. We need to understand the promise, how they use blockchain to theoretically solve gold's age-old problems. The ones that make it kind of cumbersome.
But we also have to face the trade-offs, the big philosophical questions and the financial flaws that come packaged with this digital upgrade.
It's often pitched as the perfect example of a real-world asset, an RWA successfully brought onto the blockchain. The dream is simple, the stability of gold plus the speed and flexibility of crypto. But the hook, the real question is this stuff a true safe haven on its own? Or does it just end up carrying the same volatility, the same risks as the rest of the crypto market?
That's what we need to unpack. Let's start by looking back a bit, because this isn't the first attempt at digital gold, is it?
No, not at all. It's easy to think tokenizing gold is brand new, purely a crypto-era invention. But the desire to make gold easier to use digitally, well, that goes back quite a ways. Actually predates Bitcoin by a fair bit.
Understanding those early tries, and frankly, their failures, helps explain why blockchain ended up being sort of the missing piece.
Absolutely. You really have to start with eGold, launched way back in 1996.
That was Dr. Douglas Jackson's venture, right? A radiation oncologist, interestingly enough.
That's the one. It was essentially a private digital currency, fully backed by physical gold reserves.
And it took off, didn't it? For a while, at least.
Oh, massively. It grew super fast, got something like 4 million accounts. It really proved there was huge global demand for a digital currency backed by something real, something outside the traditional banking system.
People clearly wanted an alternative.
They did. But the problem, the fatal flaw, was how it operated. It deliberately positioned itself outside the usual financial rules.
Which made it attractive for less savory activities.
Exactly. It became a hub for illicit finance, unfortunately. And eventually, the U.S. government stepped in. Serious accusations, money laundering primarily, led to its shutdown. So the big lesson there was demand isn't enough. You need structure. You need oversight, regulation, audits, trust. Trust and legitimacy, yeah. Which brings us to the next big idea, conceptually at least. BitGold.
Ah, Nick Szabo brainchild.
Yeah.
Hugely influential thinker in this space, obviously laid groundwork for Bitcoin.
Right. BitGold was this purely theoretical concept. It envisioned using proof of work, computational power to create these digital tokens linked to, well, a kind of digital scarcity mimicking gold.
A really clever idea, tying digital creation to real-world effort or cost.
Absolutely.
Yeah.
But it stayed theoretical. It was never actually built out and used by, real people in a significant way. It didn't integrate into finance. So you had eGold, successful in practice, but flawed in its governance. And BitGold, theoretically sound, decentralized, but never really implemented. Precisely. And that historical context sets the stage for where we are now. Today, if you want gold exposure, you basically have 3 main paths.
Each with its own set of pros and cons, mostly trading off like tangibility versus ease of use. Okay, path 1, physical gold, buying actual coins, bars, bullion. The pro is obvious. You own it. It's yours, in your hand or your vault. Solid.
The cons, though, they're significant. Storage costs, insurance, security worries, and it's not liquid. Try selling a big gold bar quickly on a Saturday night. Good luck.
Yeah, not practical for quick moves. Okay, path 2.
Paper gold. This is mostly things like gold ETFs, exchange-traded funds, or maybe gold mining stocks, futures contracts.
Much easier, right? You trade it on a stock exchange, just like any other stock. Super liquid during market hours, no storage hassle.
Definitely more convenient. But you introduce different risks. With an ETF, you have counterparty risk with the fund provider. With stocks, it's company performance risk. With futures, it's leverage risk. You own a contract, a derivative, not the actual metal.
You're betting on the price, essentially, not holding the asset itself.
Correct. And that brings us to the third way, the modern crypto way. Digital gold. This is PAXG, Paxos Gold, and XAUT, Tether Gold, the main players right now.
These are basically gold-backed stablecoins. The idea is one token equals or represents one fine troy ounce of real physical gold. That gold is supposedly held securely in a vault somewhere, often London or Switzerland.
So it tries to give you the best of both. The backing of physical gold, but the trading ease of a crypto token you hold in your own digital wallet.
That's the pitch. And honestly, this third option is where things get genuinely interesting because it directly addresses some of gold's oldest, most fundamental problems. Problems that have plagued gold owners for centuries, really. Exactly. Let's break those down. First up, the divisibility problem. Right. Gold bars, especially the big institutional ones, the 400-ounce good delivery bars, they're huge. You can't just shave off a corner to buy groceries.
It's physically impractical for small transactions. But tokenization, it completely shatters that barrier. These tokens can be divided almost infinitely. You can technically buy, sell, or send, 0.000000001 of an ounce.
Which suddenly makes gold investment accessible to pretty much anyone.
Yeah.
Not just banks or wealthy individuals.
Yeah.
A few bucks gets you exposure.
It democratizes access in a way that was impossible before. But hang on, let me play devil's advocate here.
Go for it.
Okay, you can technically divide it that finely, but what about the practicalities? If I want to buy just, say, $10 worth of PAXG, aren't the blockchain transaction fees, the gas fees, especially on Ethereum, going to eat up a huge chunk of that, maybe even more than the gold value itself?
That's a really important point. And yes, historically, that's been a major hurdle, especially during times of network congestion on Ethereum. The gas fees could absolutely make microtransactions uneconomical.
So the promise of infinite divisibility hits a practical wall.
It did, but it's getting better. We're seeing these tokens move to layer 2 solutions, or entirely new. Cheaper blockchains are being developed specifically for these kinds of assets. The goal is to bring those transaction costs way down. So it's more of a current technical limitation that's being actively worked on, rather than a fundamental flaw in the concept itself. The trend is towards cheaper transactions, making true fractional ownership viable.
Okay, fair enough. Technology catching up with the idea. What's the second big problem solved?
Storage and cost. This is huge. If you own physical gold, you're on the hook for storing it safely and insuring it. Vault fees aren't cheap. Security isn't trivial.
It's a constant drain and a worry.
With tokenized gold, that entire burden shifts. The issuer Paxos, or Tether in these cases, takes on the full responsibility and cost of vaulting the gold, insuring it, auditing it.
So the holder just holds the token.
Pretty much. You might pay tiny on-chain fees when you move the token between wallets, or maybe a small annual fee built into the token's structure by the issuer, but the massive headache of physical custody, that's outsourced to the centralized provider.
A significant convenience factor. And the third problem?
Fungibility and liquidity. This is a bit more subtle, but just as important.
Explain that. How is physical gold not fungible?
Well, each physical gold bar is unique. It has a serial number, a specific refiner stamp, a measured purity, a precise weight. They're not perfectly interchangeable like dollar bills are. When big bars change hands institutionally, they need to be verified, assayed, audited. It's slow. It's expensive.
Ah, I see. The verification process adds friction.
Exactly. But a PXG token.
Yeah.
Every PXG token is identical to every other PXG token. They are perfectly fungible, interchangeable units representing a claim on that vaulted gold.
And that unlocks the liquidity aspect.
Completely. Because the tokens are fungible and live on a blockchain, you can trade them instantly, 247, 365 days a year, anywhere in the world, with near instant settlement.
No waiting for bank hours, no multi-day settlement delays like in traditional markets.
None of that. It fixes gold's traditional slowness. It makes it move at the speed of the internet. That's the real digital upgrade.
Okay, so that upgrade sounds pretty compelling on paper. Let's look under the hood now. How do these companies, Paxos and Tether, actually run this as a business?
Right, because they're not charities. They're providing a service, bridging the physical and digital, and they need to make money doing it. Their main goal is to basically inject gold into the modern financial system, make it fractional, global, always available.
So how does the token actually get created? Walk us through the tokenization process. It's a neat blend of old world logistics and new world tech. So, step 1, An investor, maybe a big institution, or even through a retail platform, sends money, could be fiat currency, maybe even crypto, to the issuer, say Paxos. Okay, money goes in. Paxos takes that money and goes out and buys the equivalent amount of physical gold. Usually we're talking those big London good delivery bars, the standard 400-ounce ones.
Right, the real stuff.
That gold is then physically delivered to and secured in a high-security audited vault. Think Brinks or similar providers in London or Zurich.
Gold is locked away safely.
Once the gold is confirmed secure in the vault, the issuer interacts with a smart contract on a blockchain, typically Ethereum for PAXG and XAUT. They instruct the contract to mint, basically create new tokens exactly corresponding to the amount of gold deposited.
So 1 new ounce of gold in the vault triggers the creation of 1 new token on the blockchain.
Precisely. That token is then delivered to the investor's digital wallet, and that token acts as their digital certificate, their proof of beneficial ownership of that specific ounce of gold sitting in the vault.
And the reverse process, redemption, works similarly. Send the token back, get cash, or potentially even the physical gold minus fees.
Exactly. Though redeeming for physical gold usually has pretty high minimums and extra logistical fees, most redemption is back into cash.
Okay, makes sense. So how do they profit from this complex process? What's the business model?
We can break it down into roughly 4 main revenue streams.
All right, let's hear them.
First, and maybe the most obvious, are the creation and redemption fees. Small percentage-based or flat fees charged when you first buy the token, creation, or when you cash it out, redemption.
Standard practice for funds and exchanges.
Yeah.
The transaction cost.
Yep. Second, some issuers, notably Paxos, the PXG, charge on-chain transfer fees.
Wait, so every time I just send my PXG from my wallet to, say, an exchange or another person, I pay Paxos a small fee?
Correct. It's typically a very small percentage, like 0.02% for PXG, deducted directly from the amount transferred on the blockchain itself.
Huh. That seems different. Most crypto tokens don't have a built-in transfer tax like that, do they? You just pay the network gas fee.
It is unusual for most tokens, but it's part of PAXG's specific model. It might seem tiny per transaction, but if you imagine millions of transactions, large volumes being traded or used as collateral in DeFi, those tiny fees add up to a very significant, steady income stream for Paxos.
A microtax on velocity. Interesting. Okay, what's number 3?
Storage and custody fees.
Yep.
Someone has to pay for those high security vaults, the insurance policies, the regular audits.
Right, securing tons of gold isn't free.
Exactly. How this is charged can vary. Tether Gold, XAUT, often markets itself as having 0 custody fees, which sounds great.
But there's no free lunch, right?
Probably not. They likely make it up elsewhere in their fee structure or their float. Paxos Gold, KXG, is more explicit. They often incorporate a small annual fee, sometimes deducted pro rata from the token balance, effectively covering the ongoing costs of securing the underlying asset.
So whether it's an explicit fee like PXGs or maybe built into the spread or other fees like potentially with XAUT, the user is ultimately bearing the cost of storage.
Correct. And the fourth way they make money is very traditional, the float.
Earning interest on customer funds before they're fully deployed.
Precisely. Just like a bank holds deposits or a stablecoin issuer holds fiat reserves before minting tokens, these gold token issuers have periods where they hold customer fiat currency before it's converted into gold. Or they might hold operational funds. They invest this float in very safe, short-term, interest-bearing assets, like U.S. Treasury bills.
That seems like it could be quite lucrative, especially with large inflows or if there's a slight delay between receiving funds and actually buying the gold.
It can be. It's a standard practice in financial services, but it also highlights the importance of trust and transparency, which leads us directly into the crucial differences in how PXG and XAUT are guaranteed and regulated.
This feels like a really key distinction for anyone considering these assets. Let's compare them. PXG first.
Okay. PAXG, issued by Paxos Trust Company, is positioned as the regulated option, particularly in the U.S. Its major backing comes from being regulated by the New York State Department of Financial Services, NYDFS.
What does that NYDFS regulation actually mean for a token holder?
It means a lot. Paxos operates as a regulated trust company under New York banking law. This subjects them to strict capital reserve requirements, rigorous safety and soundness checks, and mandatory compliance with KYSML regulations. Know your customer and anti-money laundering rules.
So more like a traditional financial institution in terms of oversight.
Yes. And critically, that regulated status provides a degree of asset protection. If, hypothetically, Paxos were to face bankruptcy, customer assets held in trust are supposed to be segregated and protected from the company's creditors. There's a clearer legal path for customers to reclaim the underlying gold.
That sounds like significant peace of mind compared to unregulated alternatives.
It is. Plus, the NYDFS mandates regular public attestations. Paxos publishes monthly reports, usually verified by a major accounting firm like KPMG, confirming that the amount of PXG tokens in circulation matches the amount of gold held in vaults.
Monthly audits by a Big Four firm. That's robust. And the gold itself.
It has to meet the London Bullion Market Association, LBMA, good delivery standard minimum 99.5% purity, and it's held in approved, secure vaults in London.
Okay, so PASG emphasizes regulatory certainty, transparency through frequent audits, and clear legal status. Now, contrast that with XAUT Tether Gold.
Tether Gold comes from the same company behind the massive USDT stablecoin. They're a veteran in the crypto space, but operate under a different regulatory philosophy. They don't have that NYDFS charter or equivalent major U.S. regulatory license.
So where do they get their legitimacy?
They rely more on their established reputation in the crypto market, contractual agreements with users, and licensing in other jurisdictions. They've mentioned places like El Salvador. The guarantee is essentially Tether's promise to redeem the token for gold.
And their audits.
They do provide attestations of their reserves, but typically these are quarterly opinions, not full audits in the traditional sense, and they've been provided by firms like BDO Italia. While BDO is a reputable firm, the frequency is less than PXG's monthly reports, and the oversight isn't mandated by a regulator like the NYDFS.
So quarterly attestations versus monthly, and regulatory mandate versus company choice.
Exactly. The gold standard is the same LBMA good delivery, but it's typically stored in secure vaults in Switzerland rather than London for PAXG. So the fundamental difference boils down to this. With PXG, you're placing a large part of your trust in the NYDFS regulatory framework overseeing Paxos. With XAUT, you're placing more trust directly in Tether, the company, its operational history, and its chosen auditors. That's a very good way to put it. Regulatory certainty versus relying more heavily on corporate reputation and contractual promises.
And that distinction, that reliance on a central issuer like Paxos or Tether, brings us right to what many see as the fundamental flaw, or at least the core tension in crypto gold.
Yeah, the IOU problem, it really clashes with the original spirit of crypto, doesn't it?
Completely. The whole point of Bitcoin, of decentralization, was to eliminate the need for trusted third parties, right? To create a system where you don't need a bank or a custodian or a central authority. Don't trust, verify.
But tokenized gold, it puts that trusted third party right back in the center. By its very nature, it requires centralization. Someone has to physically hold the gold.
So the token you hold in your wallet, it isn't actually the gold.
Nope. It's a digital representation. It's essentially an IOU issued by Paxos or Tether, promising that they hold the gold and will give it to you if you redeem the token.
I remember CZ, the former head of Binance, making that point quite strongly. He said it's not on-chain gold, it's just a token representing a promise from a third party.
He's fundamentally right. The actual asset, the gold, sits off-chain in a vault. The token is just a claim on it, a digital receipt that relies entirely on that centralized issuer acting correctly.
So, in exchange for solving gold's logistical problems, divisibility, storage, liquidity, you sacrifice the core crypto ideal of trustlessness.
That's the bargain. And accepting that bargain means you re-import several major risks that crypto was supposed to eliminate. Risks familiar from traditional finance.
Okay, let's break those down. What's the first major risk?
Counterparty risk. This is the big one. Your token's value and utility depend entirely on the issuer, Paxos or Tether, staying in business, remaining solvent, operating honestly, and not getting hacked or shut down.
So if the issuer goes bust?
If the issuer fails, your instantly tradable digital tokens suddenly becomes, well, a legal claim. You might technically own the underlying gold if they're regulated like Paxos, but you'd have to go through lengthy, expensive bankruptcy proceedings to try and get it back. The liquidity vanishes overnight.
That's a stark difference from holding, say, Bitcoin in your own wallet, where there's no issuer to fail.
Or even from holding physical gold with a custodian. If your vault provider fails, the gold itself still exists as your distinct property, hopefully segregated. With a token representing a claim on a pool of gold held by an issuer that collapses, recovering your specific share becomes much more complex and uncertain, especially across different legal jurisdictions.
So the risk isn't just shifted, it's kind of magnified by the digital layer. In a way, yes, the failure of the digital bridge, the issuer, instantly impacts the usability and value of the token, even if the underlying gold is safe. Okay, second risk. Custody risk. This is about whether the gold is actually there
Right.
and properly accounted for. Exactly. The whole system relies on that 1.1 backing being true at all times. The gold has to physically exist in the vault. It mustn't be pledged or leased out for other purposes, a practice called hypothecation, and it can't be double counted, which puts enormous pressure on the audits.
Absolutely.
You have to trust the auditors, KPMG for Paxos, BDO for Tether, are doing their jobs thoroughly, independently, and accurately. You need to trust the vault security. If there's any failure in that custody chain, if the gold isn't really there, 1.1, the token could rapidly become worthless, regardless of what the blockchain says. Trust, but verify.
Right.
But the verification itself relies on trusting another intermediary, the auditor.
Precisely. And the third major risk, which might be the most jarring for crypto believers, is censorship risk.
Because the issuer controls the token contract.
Yes. Unlike Bitcoin, which is permissionless and decentralized, the smart contract that mints and manages PAXG or XAUT tokens is controlled by the central issuer, Paxos or Tether.
Meaning,
if they are ordered to by law enforcement or a regulator, say, due to sanctions or a criminal investigation, they have the technical ability to freeze specific tokens in specific wallets. They can blacklist addresses.
so your tokenized gold isn't truly censorship resistant like Bitcoin might be. It can be seized or frozen remotely by the issuer under legal duress.
Correct. It inherits the susceptibility to control and censorship that comes with operating within the regulated financial system.
So wrapping up this section on trust, the key takeaway for you listening is that tokenized gold is a hybrid. It's not fully trustless crypto.
No, it's perhaps best described as trust minimized. The
Ah.
blockchain provides transparency on the token side, the audits provide verification on the gold side, but you are still fundamentally trusting the issuer and the auditors.
You have to continuously trust and continuously verify their reports and compliance. It's a compromise. Okay, so we've established the structure, the business model, and the inherent trust compromise. Now for the big question. Does it actually work as a financial asset? Does it deliver stability, especially when markets get rough? To judge that, we probably need to quickly revisit gold's own track record first. There's this popular idea that gold is this ultimate inflation killer. Yeah, the narrative is strong, buy gold to beat inflation. The reality, though, is more nuanced. Hesitant, maybe, perhaps. It definitely preserves value over the very long haul. That famous example comparing a Roman centurion's pay in gold to a modern army captain's salary holds up surprisingly well.
Across millennia, it holds purchasing power. Remarkable, really.
But as an investment, say, over decades, it's much less consistent. Think about the 80s and 90s.
Right. From the mid-1980s to the early 2000s, you had inflation, but gold prices actually trended down for nearly 20 years. Holding gold then meant you were losing real purchasing power compared to other assets like stocks.
So it's not a growth engine. It's more like insurance.
That's a good analogy. It acts like an insurance policy. It tends to spike during periods of high unexpected inflation or major geopolitical crises, or when faith in fiat currencies collapses. It holds the line, provides ballast, but it rarely leads the charge in wealth creation.
Okay, so that's physical gold. A long-term value preserver, a crisis hedge, but inconsistent for growth. What happens when you digitize it and stick it onto crypto exchanges? How did tokenized gold perform during a real crisis?
Well, we have some academic research that looks specifically at this during the COVID-19 pandemic period, roughly March 2020 to August 2021, a time of huge global uncertainty and market volatility.
And what did the researchers find? Did PXG and XAUT act like stable digital gold?
Actually, no. The findings were quite surprising and maybe disappointing for proponents. The research indicated that these gold-backed cryptocurrencies were very much caught up in the turmoil. They seemed susceptible to volatility spilling over not just from the physical gold market, but also from the wider crypto market itself.
So they didn't decouple and act as a stable anchor. Not effectively, according to this research. The core finding was that despite being pegged 1.1 to gold, the volatility and the risk associated with trading tokens like PAXG and XAUT actually remained comparable to Bitcoin during this period. Wait, hang on. Comparable volatility to Bitcoin? How is that possible if the price is pegged to relatively stable gold?
That's the key. The price peg is one thing, but the realized volatility when trading the asset on crypto exchanges is another. Crypto exchanges, especially for newer or less liquid assets, can have thin order books. Market makers might pull liquidity during stress.
Meaning a single large trade can cause the price to swing wildly, even if momentarily.
Exactly. That leads to high realized variance or volatility, even if the underlying peg to the gold price eventually reasserts itself. The research suggested the trading environment, the mechanics of the crypto market where these tokens live, introduced significant volatility that wasn't present in physical gold itself. The digital wrapper added risk.
So the stability of the underlying asset was undermined by the instability of the trading venue.
That seems to be a major factor identified in the COVID-era studies, and it gets worse. Some of the other gold tokens studied, like DGX and TMTG, actually showed periods where the realized variance was higher than both physical gold and Bitcoin.
Higher volatility than Bitcoin for a gold-backed token. That completely defeats the purpose.
It does seem counterintuitive, but it highlights the impact of liquidity and market structure on these nascent digital assets. The research also looked at risk metrics, finding some interesting differences.
Like what?
Well, tokens like PAXG, Gold, PAXG, and TMTG showed signs of persistence in their volatility.
Persistence, meaning if volatility spiked, it tended to stay high for a while.
Yeah, suggesting that high risk wasn't just a brief shock, but potentially a more ingrained, longer-run characteristic, perhaps reflecting the risk profile of gold itself, or maybe issues with the token's market structure. In contrast, another token, DGX, showed more mean reversion. Its risk tended to snap back to average levels more quickly after a shock.
Different risk dynamics for different tokens, even though they're all supposedly backed by gold.
Suggests the issuer, the market structure, the liquidity profile all play a big role in how these tokens actually behave under stress.
And you mentioned something even more concerning about market integrity, Benford's Law.
Ah, yes. This was a particularly interesting and potentially worrying finding in some robustness tests. They looked at the distribution of the first digits in the reported trading volumes for several tokens, including DGX, PAXG, and Tether, though likely referring to USDT here, the principle applies.
Okay, remind us what Benford's Law is about.
It's a statistical observation that in many real-world data sets involving numbers, like populations, accounting data, sometimes trading volumes, the leading digit isn't evenly distributed. The digit 1 tends to appear as the first digit about 30% of the time, 2 pence about 17%, and so on down to 9 appearing less than 5% of the time.
Right, it's a known pattern in naturally occurring numbers.
Exactly. And when a data set deviates significantly from this expected Benford distribution, it can sometimes be a red flag. It might suggest the numbers aren't naturally occurring, perhaps due to manipulation, fabrication, or errors in reporting.
So the research found that the trading volumes reported for PAXG, DGX, and Tether didn't follow Benford's Law.
They showed statistically significant deviations. Now, this doesn't automatically prove manipulation. There can be other reasons, but it does raise questions. It suggests potential anomalies in the reported liquidity figures, the very data investors rely on to gauge market depth and trading activity.
Unsettling for assets meant to be stable and transparent? It is. So the overall conclusion from the COVID-era performance analysis was pretty stark. During that major global crisis, tokenized gold largely failed to deliver on its promise of being a significantly less volatile safe haven compared to mainstream crypto like Bitcoin. It seemed to inherit crypto's volatility while also being susceptible to issues in the gold market. It is. So the overall conclusion from the COVID-era performance analysis was pretty stark.
Okay, so that paints a rather bleak picture if you're looking at it purely as a replacement for physical gold during a global macro meltdown, but that's only half the story, right? Exactly. This is where the paradox comes back in full force. Because while it might have failed that specific stress test, tokenized gold has found tremendous utility within the crypto ecosystem itself.
This is the real-world asset success story angle, bringing something stable into DeFi.
Precisely. Think about decentralized finance, DeFi. Historically, what's the main collateral used in lending protocols like a POV or Compound? It's mostly highly volatile crypto assets like Ether or Bitcoin.
Which means loans can get liquidated very quickly if the market dips.
Right. Introducing tokenized gold, a globally recognized asset with relatively lower volatility compared to ETH or BTC, and low correlation to them, acts as a stabilizing force. It provides a different, more robust form of collateral for the DeFi system. That's been a key driver of the RWA trend.
So what are the concrete ways people are using it in DeFi? Well, 3 main use cases stand out. First, gold-backed loans. This is huge. Instead of selling your gold position, you can deposit your PXG or XAUT into a lending protocol and borrow stablecoins against it. So you get liquidity without giving up your exposure to gold's potential upside.
Exactly. You leverage your gold holding to access cash, essentially. Second, it serves as a better stablecoin alternative, or at least a different one.
How so? Aren't dollar stablecoins like USDC or USDT the standard?
They are, but they come with their own risks. We've seen stablecoins depeg from the dollar, face regulatory crackdowns, or carry counterparty risk with their issuers. Gold tokens offer an alternative peg.
Yeah.
If you're worried about dollar inflation or the stability of a specific dollar stablecoin, you can instantly swap into PXG or XAUT with a click. It's a dynamic hedge within the crypto ecosystem.
A quick way to shift risk exposure without leaving the blockchain.
Right.
And third use case, gold farming yield. This turns gold from a passive asset into an active one. How does that work? Physical gold just sits there, costing you storage fees.
But tokenized gold can be put to work. You can provide liquidity for a PXG USDC trading pair on a decentralized exchange, for example. By doing so, you earn a share of the trading fees generated by that pool, plus potentially other token rewards from the platform.
So you're earning yield on your gold.
You're turning a historically non-productive asset into a yield-generating digital asset, available 204/7. That's quite revolutionary for gold holders.
Okay, so it has clear utility within DeFi.
Right.
But how does it perform as a hedge or safe haven against other crypto assets, especially during crypto-specific downturns?
Now here, the data looks much more positive. Research analyzing the really brutal 2022 crypto bear market, think the Terra Luna collapse, the FTX implosion, tells a very different story than the COVID analysis.
What did that research show?
It found that during normal crypto market times, gold-backed tokens generally act as decent hedges or diversifiers, meaning they tend to move somewhat with the market, but not perfectly, helping to smooth out portfolio returns.
Okay, positive but not lockstep correlation.
Right. But during times of extreme crypto-specific stress, like those major collapses in 2022, these tokens acted as robust safe havens.
Safe havens specifically for other crypto assets.
Yes, particularly for the most volatile segments like NFTs and many DeFi-specific tokens. When those sectors were imploding, money seemed to flow into the relative stability of tokenized gold.
That's a really important distinction. It didn't protect against the global macro shock of COVID, but it did protect against internal crypto market shocks.
Precisely. And the research even ranked the effectiveness. It identified PXG, Paxos Gold, and PMGT, Perth Mint Gold Token, another regulated offering, as being the most effective safe haven instruments for both NFT and DeFi token portfolios during that period.
Better than other gold tokens like DGX.
Apparently so, according to that specific analysis. It suggested PXG and PMGT had a higher capacity to mitigate risk coming from those volatile crypto sectors, perhaps due to their stronger regulatory backing and perceived stability compared to less regulated alternatives.
So what's the takeaway for someone managing a crypto portfolio? The implication is pretty clear. For sophisticated investors or portfolio managers operating within the digital asset space, assets like PAXG or PMGT are becoming almost essential tools for dynamic hedging, meaning you actively use them to offset risk from other holdings.
Yes. The analysis even explored optimal hedge ratios, suggesting how much PXG you might need to short or long to best neutralize the volatility of, say, an NFT collection or a risky DeFi investment. It's becoming part of the advanced crypto toolkit.
So the performance picture is really nuanced then. It behaves like volatile crypto when the whole world is shaky, possibly due to thin exchange liquidity.
But it behaves more like traditional gold, a stable, non-correlated haven when the crypto market itself is experiencing internal crises, especially in its riskiest corners like DeFi and NFTs.
It's a defensive asset built for the digital world, rather than a perfect bridge to the traditional world under all conditions.
That sums it up quite well. Its primary strength seems to be internal to the crypto ecosystem.
Okay, let's try to bring this all together. We've covered a lot of ground on this hybrid asset class. Crypto gold, like PAXG and XAUT.
It's undeniably a clever innovation. It tackled those ancient problems with physical gold, making it divisible, easy to store digitally, instantly tradable. It wrapped gold in a blockchain layer.
But that convenience, that digital wrapper, came with a significant trade-off, didn't it?
It absolutely did. It fundamentally swaps the crypto ideal of pure trustlessness for regulated centralized control and custody. You gain liquidity, you gain fractional ownership.
But you brought back counterparty risk, trusting the issuer.
Yeah.
You brought back custody risk, trusting the gold is really there and audited correctly. And you brought back censorship risk. The issuer can freeze your tokens.
Those traditional financial risks came bundled with the digital benefits.
And the performance data we looked at really reflects that duality, that compromise.
Yeah, during the broad macro stress of the pandemic, the academic findings suggested they got pulled into the crypto vortex, showing volatility surprisingly similar to Bitcoin, perhaps because their liquidity on crypto exchanges was fragile. The stable peg didn't guarantee stable trading.
But then shift the focus. Look at them within the crypto ecosystem during the 2022 crypto winter.
And suddenly they shine. They proved to be effective, even robust safe havens, against the implosion of high-risk digital assets like NFTs and complex DeFi tokens. They provided internal stability when parts of the crypto world were collapsing.
A necessary tool for navigating the internal risks of the digital asset space itself.
Exactly. And it's really telling, isn't it, that the token often highlighted as the most effective safe haven in those studies, PAXG, is the one with the most rigorous traditional regulatory backing the NYDFS oversight.
That connection between regulatory compliance and perceived stability within crypto seems crucial.
It really does. Which leads us to a final, maybe provocative thought for you, the listener, to mull over. If the most successful examples we're seeing of integrating real-world assets onto the blockchain, like PAXG arguably, are the ones that lean heavily on traditional financial regulation and centralized trust, what does that really mean for the future? Is the path forward for RWAs not pure decentralization, but actually this kind of hybrid model, a marriage of blockchain's efficiency with the trust and oversight of established regulation?
And if that is the most viable path for bringing real-world value onto blockchains, what does that imply for the original, more radical vision of a completely trustless, decentralized financial system? Does regulation become a necessary feature, not a bug, for mass adoption?
It's a fundamental question about where this whole space is heading. Reconciling the decentralized ethos with the practical realities of global finance and user trust.
Something to definitely keep thinking about. Well, that brings us to the end of this deep dive into the complex world of digital gold. Thanks for joining us.
Yeah, thanks for tuning in. We'll catch you on the next one.